As many economists have recently begun forecasting that the U.S. will sink into a recession next year, 2023, our next guest made that call early on, in early 2022, saying that the economy had significant near-term momentum that would later on lead to market imbalances. That's Deutsche Bank's chief U.S. economist, Matthew Luzzetti, who joins us now and still maintains that view. He joins us here in Living Color, live in Living Color. All right, so since you predicted the factors that would lead to or trigger a recession, what would you look towards in terms of the flashing signs in order to lead us out of a recession, or the light at the end of the tunnel, perhaps?
Sure. So I still think there's a lot of uncertainty about the timing of recession. We've maintained a call that it's the second half of next year. And I think we've seen a lot of evidence that I think supports that. In the near term, we just saw GDP getting revised up in Q3. We do still think that there's meaningful momentum. Q4 growth looks okay. I think in Q1, you still have decent momentum. But as you get towards the middle of next year, I think that's where the risks begin to build. I think a key part of that is the U.S. consumer and the drawdown in excess savings that is ongoing. And so I think you'll see a consumer that looks a lot more fragile in the middle of next year. In terms of what we're looking at, I think it's all about the labor market. When does the labor market really begin to show signs of slowing? I think continuing jobless claims are typically our best real-time indicator of recession. As we saw this morning, they remain very low. So you have a labor market with a lot of momentum in the near term. I think that'll keep the Fed raising rates. Ultimately, though, I think that does mean that we have tighter financial conditions as you head into next year and a slowdown in the economy in the second half of the year.
Do you still think there's any chance that we get a recession here where we don't see a spike in unemployment? Or is that, the Fed has said it doesn't think that's going to happen, that we're going to start to see unemployment move towards 4% and beyond.
Yeah, I think when you look at the Fed's forecast, it is as close to recession as you can kind of get.
Without calling it a recession?
Yes. There's three officials that actually have negative growth forecasted for next year. But at the same time, it would be the lowest unemployment rate rise that you've ever seen in a recession. Recessions, typically if the unemployment rate rises by 50 basis points, it just accelerates from there. And so I think a key question is, I guess, one, when does that begin to happen? We don't think it really begins to happen until the middle of next year. And two, how much is the rise in the unemployment rate that we anticipate? We expect that you'll see about a 2 percentage point rise in the unemployment rate, which does sound like a lot, I think. But from a historical perspective, it's actually a quite mild recession. And there, I think you have employers that have a lot of incentives to keep labor. We're still a very tight labor market. I think they found out with COVID that it was difficult to go back and then rehire if it was a temporary slowdown. And so I think some of those kind of labor hoarding incentives will probably keep a cap on how high the unemployment rate will rise.
And I was reading a good feature by our Jen Schomburger on the year that has been for the Fed. It's been quite the year. As someone who covers the Fed and what they do, what grade would you give them in terms of performance this year?
Look, I think if a year ago, if we would have said that they would have hiked rates by over 400 basis points this year, I think it would have been absolutely shocking. I think the starting point from where they were offsides in terms of where the inflation was, as many of us were, in terms of how tight the labor market got, how high inflation began to rise. I think they did a really good job this year of right-sizing monetary policy. They caught up very quickly. They took bold steps to take 75 basis point rate increases at 4 consecutive meetings. I think that has left them in a good spot at this point. It doesn't mean, I think, that the base case is a soft landing, but I think that they have maximized their chances in order to get a soft landing. For what you're seeing with consumer right now and debt levels, you mentioned a moment ago some of the savings are already beginning to be tapped, but where is debt starting to pile up on the consumer front? And even in the shift of spending right now, we're seeing more consumers lean on credit cards and things of that nature in order to get them through to the other side. Yeah, credit card growth has been very strong recently, but I think there's important context, which is we're basically catching up to pre-COVID trends and levels that we would have seen. Typically, you want to normalize those debt burdens by income or disposable income. And the consumer really looks good on those metrics still. So the way that I read that data is it's early signs that a good portion of the income distribution is beginning to eat through their savings that they've had. It's meant that they are now needing to fuel consumption by borrowing. I think a key data point is what you've seen with the U.S. savings rate. Over the past 3 months, below 3%, basically record low levels. That's very clearly an indication that savings are being drawn down very quickly. And as we head into next year, I think debt is a more important driver of consumer spending trends.
Matt, as we go into next year and as you have this sort of base case forecast, are the risks more to the upside or the downside? Like the rhetoric feels more downside-y. But which way would you go if you had to guess, like, where could surprises come from?
Yeah, I think if anything, the risk to our view is that the recession comes a little bit later. that we don't get it by Q3 or the middle of the year, that the labor market just has a bit better momentum, that good momentum feeds into consumer spending that remains more resilient, and that pushes out the timing of a recession. I don't think that necessarily tells us that we won't have a recession, perhaps by early 2024. I think what that'll mean is that the Fed will likely have to raise rates more, wage growth will be more persistent, price inflation will likely be more persistent, but that the whole manifestation of the recession just takes a little bit longer.
It's been fun following your work all year. Appreciate you always coming on. Happy holidays. Matthew Luzzetti, Deutsche Bank Securities Chief U.S. Economist. We'll talk to you soon.
Thanks so much for having me.